Hello traders, Doc here. In this video I will share my opinion about chart patterns based on my experience, and I will rate them from the worst to best. Chart patterns are an important tool when it comes to trading, but some of them are useful and some of them are not very useful. I will rate chart patterns that we can see here on this picture, and at the end of this video I will show you a chart pattern that nobody talks about, but it's very important. First, I want to start with the chart patterns that are not very useful. I will start with a diamond chart pattern. This pattern has a shape of a diamond, that's why it is called a diamond chart pattern. And from my experience, this chart pattern rarely occurs and it is not very useful. In my career, I saw it just a few times and I didn't even trade it. What we can see here is basically consolidation. And we can connect these bullish and bearish trend lines and form this shape of a diamond. We want to trade this pattern when price breaks our trend line. But from my experience, this is not very good pattern, because many times price will break it here, maybe form some weak rejections, false breakouts, and at the end of the day, this is just a consolidation. In my opinion, this is very useless chart pattern, and I don't recommend you to trade it. I managed to find this example to show you on a chart, and as we can see here, we can connect these trend lines. Price broke our pattern and went down, and that is good thing because we want to enter after a breakout. As we can see here, this basically represents a consolidation. And like I said many times, there will be false breakouts and weak rejections here. So it can easily give a false breakout signal. Because of that, I recommend you to avoid this pattern. Next pattern is cup and handle chart pattern. What we have here is a shape that basically looks like a cup. And then we have this handle. This handle is basically a reaction to this previous high. And some traders use Fibonacci tool to determine where this pullback or handle will end and where will price continue to go up. So we have this shape here that looks like a half of a circle, then we have this handle or a pullback, and then price continues to go up. Just like a diamond, this chart pattern rarely occurs, and it is a pattern that I don't consider is valuable. I don't think that you should waste your time to find this pattern and then try to trade it, but I will show you right now how it looks like on a chart. Here we can see this move that looks like a cup, basically a half circle, and then we have a pullback or this handle. We can see then that price broke this previous high with this bullish candlestick, and then it continued to go up. This time it worked, but again, I don't recommend you to waste your time to find this pattern. Next pattern is this broadening triangle. It consists with these two trend lines, one bullish trend line that is connecting these higher highs and one bearish trend line that is connecting these lower lows. Again, we want to trade this pattern when a breakout occurs, like here. But in my opinion, there is one very big problem with this pattern, and that is the fact that we are entering after this new higher high formation. Or in a case of a downtrend, we should enter here, but basically that is a formation of a new lower low. Usually in trading you want to wait for a pullback and then enter in order to get good entry level, but here we are actually entering after a new higher high formation, or we are entering after a new lower low formation. Because of that, I don't consider this pattern very useful, and also it occurs very rarely. From my experience, this is a pattern that you should not focus on, but of course, like any pattern, it can work sometimes. Here we can see one example of this bullish trend line that connected these higher highs, and then we can see this bearish trend line that connected these lower lows. Price broke our trend line here, and then we can see this massive bullish move. This time this pattern worked and price continued to go up after this breakout, but many times this entry level will be too late because price will form some kind of a pullback and maybe then go up. But if you use narrow stop loss, let's say below this weak rejection, there is a high probability that price will first go down to form some kind of a pullback, take your stop loss, and then eventually go up. Now we will start with the patterns that are actually good, and if you trade them the right way, they can be useful. That pattern is what we call consolidation and also rectangle. They're basically the same thing, except the rectangle actually has two touches, but these are the rules that honestly anybody can make, and because of that I will consider this pattern as a one pattern and call it consolidation pattern. What happens in a consolidation is that price moves between a certain resistance and support levels. With a consolidation, we basically have a price that moves between resistance and support zone. We can see here that price touched support and resistance zone many times, and eventually it broke it. Again, like majority of patterns, we want to trade after a breakout, and on this example here, we can actually see that price broke our resistance zone and then continued to go up. So consolidation means that basically bulls and bears are satisfied with the price, and there are no big moves that you can catch here. Of course, you can always trade a consolidation by moving on the lower time frames, but that is very risky and you should definitely avoid to trade it. You can enter after a breakout, but only with a good plan. On this example here, we can actually see that price formed this higher low and then it broke this previous high. So now we have some information that is telling us that bulls are gaining the control. Price then started to consolidate for a very long time, and then it eventually broke it here. If you look closely, you will actually see that price formed this new higher low here, which was another indication of a potential bullish break, and as we can see, that is exactly what happened here. So if you are able to spot these signs, then you can trade consolidation after a breakout, but usually you want to avoid behavior like this. Here we can see another example where we have this aggressive downtrend and then price started to consolidate. So suddenly bears are losing the control, maybe all these sellers here are taking their profits and the price is slowing down, and we can see these moves between this support and resistance zone that are basically untradeable. Eventually we can see this strong bullish move that broke this resistance zone. This was the first indication that price will go up. Then we can see that price actually retested this previous resistance zone, and then we can see this bullish pressure and then price moved up. Of course, this knowledge can be applied in uptrend too, where price goes up, then we can see consolidation, then we can see break and retest, and then finally a reversal. So if traded right, this pattern can be useful. We can actually see this consolidation on gold. We can see this bullish and bearish move that are basically untradeable. We have this resistance zone and this support zone. Price broke it, continued to go down, but eventually we can see this bullish move, and of course, like any pattern, this will not work every time and it is very hard to trade it, so the best move is to avoid it until you see a breakout. Next good pattern is called head and shoulders pattern, and we also have inverse head and shoulders. Basically it is a pattern where we have these three highs. We have this high here, then higher high occurs, and then lower high occurs, and this lower high is basically at the same level where this first high occurred. So we basically have these two shoulders and head. That's why this pattern is called head and shoulders. Here we have a lower low formation, then we have a lower high formation that is at the same level as this previous low. You want to trade this pattern after a breakout, of course. I saw this pattern many times and you will likely see it too. It is actually a good pattern that you can enter after a breakout or a retest. You can see some examples of an entry point. First example we can see here where you can enter after this second shoulder formation. This is very risky because of course we don't know if price will go down. Maybe price will form this bearish move and then continue to go up, so this pattern will fail, and because of that it is risky to enter here assuming that this pattern will fully form. The best entry is after neckline breakout, and you can put your stop loss above this previous high and aim for a good risk reward ratio, but the safest way is to wait for a retest. Of course, retest will not occur every time, and that is the risk when it comes to retest, but it usually gives us a better entry point. And of course you can enter after a breakout, and if you see some weak rejections here, price can break this neckline, form multiple weak rejections, which is another sign of a bearish pressure, so you can enter there. Here we can see multiple examples of a head and shoulders pattern. I believe this was Euro-British pound pair where I found this behavior. It is very interesting because rarely you will see three chart patterns formed one after another. This happened here, and we can see that price broke our neckline, continued to go down. Then we have the second head and shoulders, but this time we have this angled neckline, which is also okay. We have left shoulder, right shoulder and a head. Price broke this neckline and continued to go down again. These two highs are at the same level, and these are our shoulders, left and right. Price then goes down to break this neckline, and we can see that price continue to go down again. Sometimes you will see a consolidation as a shoulder, as we can see here, price from this minor consolidation area and then continue to go down. But anyway, the point is the same, that we have a lower high formation that is at the same level as this first high formation. I consider this pattern to be useful, and you can use the plan that I previously showed you to trade it. Next pattern is the triple top and triple bottom. This is an example of a triple top, but you can find many examples of a triple bottom too. This is good pattern because basically what we have here is a formation of a resistance zone. We can see that price from this first high, then second high occurred but failed to break it, and then finally we have another bullish move that also failed to break these previous highs. We can easily say that price basically from this resistance zone, but because we can see these three touches or three tops, we call this triple top pattern. After the third pattern, you will usually see strong bearish move that breaks this neckline, and then again we can see this bearish continuation. On this example, we actually have a retest of this neckline here, and once the price retested this previous neckline, it also formed a new triple top. We can see this first top, then bearish move, second top, bearish move, slow down, bullish move. And this is the third top. Price then went down to break this neckline and then continue to go down. Neckline is this zone or trend line that connects these lows here. We have these highs, these are our tops, and we have these lows, and when you connect these lows, you get this neckline. The same logic applies here with the head and shoulders that I previously explained. We have three tops, basically left, right shoulders and head, and also we have these lows that we can connect, and when we connect them with a trend line or a zone, we get this neckline. So these two patterns are very similar, except this second top is the highest with the head and shoulders, but with the triple top, all these highs are at the same level. This is useful pattern because at the end of the day we have this resistance formation, and resistance and support zone are very important zones that every trader should know about. This example is very unique because price retested our neckline with another triple top formation. This will not occur very often, but anyway, price can go up, retest the neckline and then continue to go down. Again, you can enter here, which is a risky entry. You can enter here after a breakout, which is a good entry, and you can enter after a retest, which is very safe entry and the best entry that you can find. Triangles are very good patterns, except this broadening triangle that I talked about. So now we have this symmetrical triangle, we have ascending triangle and descending triangle. Descending triangle consists with this bearish trend line and this support zone. This bearish trend line is connecting our lower highs and we have support zone. Once the price breaks our support zone, we want to enter, and then what we usually see is a move down. Sometimes price can go up, break our trend line and then continue to go up. The best way to trade them is to wait for the price to break support or here resistance zone, but sometimes this pattern can break a trend line like this or like this and then continue to go up or down. The main way to trade these triangles is to wait for the price to break support zone here or resistance zone here. With ascending triangle, we have resistance like I said, and we have this bullish trend line that is connecting our higher lows. The reason why this pattern is good is because we already have this lower highs formation. There is no bullish power. Buyers are not willing to pay a higher price, and that's why we have these lower highs formations. So eventually, once the price breaks our support zone, it is very reasonable to enter a sell trade. Also here with ascending triangle, we have this series of higher lows. This means that buyers are willing to pay the higher price than before, so as the time goes by, buyers are entering at the higher levels. But there is a certain price at this resistance zone that they are not willing to pay. Eventually, when the price breaks this resistance zone, it is reasonable to enter a buy trade. When it comes to a symmetrical triangle, we have one bullish and one bearish trend line. It's a series of lower highs and series of higher lows. So what we want is to enter after a breakout. But there is one tip here that I want to show you, and this depends on a previous trend. If we have uptrend and then this pattern occurs, what you want to do is to wait for a breakout first, of course. But if you have uptrend and price breaks our bearish trend line, then you can enter after this breakout because it is expected for the price to go up and to see continuation of this previous trend. But if price breaks this bullish trend line, you usually want to wait for a retest and another confirmation because now this pattern represents a reversal pattern. So that's why it is better to wait for a retest and another confirmation that price is about to reverse. That is what we have on this example. We have this bullish move, then price broke our bullish trend line, then retest occurred and then price went down. But here we have downtrend, price broke our bullish trend line and then it just continued to go down. So in this case, you don't have to wait for a retest and the previous trend are not aligned, then you want to wait for a retest. So to simplify, you have uptrend, price forms a bullish break, you want to enter. You have uptrend, price forms a bearish break, you want to wait for a retest. Here, you have downtrend, price forms a bearish break, you can enter. Or price forms a bullish break, you want to wait for a retest. I traded many triangles and I see them very often and usually they give good signals. So once you spot them, you can definitely form your strategy to trade them. So these are the good patterns and now I will show you the best patterns that you can trade. And finally, we have these very useful patterns. These patterns I like to trade, I trade them often and I recommend you to consider adding them to your trading strategy. First very useful pattern is called Vetch Pattern. We have rising and falling wedge. What we expect from this pattern depends on a previous trend. Here we have these two bullish trend lines and what we can see is that these two trend lines will eventually cross each other. So if you imagine that this trend line is infinite and also this one, eventually they will cross each other. Also here, if you continue to draw this trend line and this trend line, they will eventually cross each other. So if we have uptrend and rising wedge occurs, we want to wait for the price to break this trend line here and then look to enter a sell trade. If we have downtrend, we want to wait for the price to break also this trend line and then we want to enter a sell trade. As you can see, this pattern and this pattern are the same, but the difference is this trend here. Here we have downtrend, here we have uptrend. Also, we have this falling wedge. In an uptrend, we want to wait for the price to break this trend line and then look for the opportunities to enter a buy trade. Here, in a downtrend, we also have these two trend lines and we want to wait for the price to break this trend line and then again look for the opportunities to enter a buy trade. I traded this pattern many times and I consider it to be very useful. Here we can see downtrend and then price broke our trend line here and then continued to go down. Again, we have this series of higher highs, lower highs, price broke our trend line and continued to go down. Then again, we can see third wedge here, higher highs, higher lows, breakout and bearish continuation. I consider this pattern to be very useful because of the fact that price formed these higher highs, but as we can see they are not much higher than the previous high. Basically that tells us that there is not enough bullish power. They are still in the control, but they are not able to push the price much higher than a previous high. And that's why you get these higher highs, but they are eventually losing the power. You can actually see that bulls are not willing to pay much higher price, and they are losing the interest of this certain asset. Yes, they are in the control, we have higher highs and higher lows, but you can actually see that they are not able to push the price much higher. And many times this pattern is an early call because it gives us indication that price will continue to go down in this case, but it gives us very early and very good signal. You want to enter after a pullback, so in a downtrend what you want is to wait for a pullback and then ideally to enter here. And that is exactly what this pattern gives us. It basically forms a pullback and then slows down and then price breaks our trend line, and that is very good signal that price will go down. I traded this pattern many times and it worked many times. I definitely advise you to consider adding this pattern to your trading strategy. Next very useful pattern is called flag pattern. This pattern is very similar to the wedge, but this time we have two trend lines that are parallel. If we continue to draw these trend lines, they will never cross. So these two trend lines are parallel and they look like a flag. That's why this pattern is called a flag pattern. It occurs both in an uptrend and downtrend. In an uptrend we want to enter and buy when price breaks this trend line, and in a downtrend we want to enter and sell once the price breaks this trend line. With this trend line we have this formation of lower highs and also lower lows. In a downtrend we have formation of a higher highs and also higher lows. Here we can see example with the two flag patterns. Price broke it here, continued to go down, and then again we can see this flag pattern. Price retested its previous lows, from this massive bearish candlestick, broke this trend line and continued to go down. This is something that I saw countless times, and that is why I consider this pattern to be very useful. And finally, the best pattern, double top and double bottom. When it comes to a double top, we basically have these two highs that are at the same level. From my experience, this is simply the best pattern, and I absolutely advise you to focus on this pattern and add it to your trading strategy. The best way to trade this double top is to wait for the price to break this neckline or this previous low and enter, and of course you can be extra safe and wait for a retest and then enter. So with a double top we have this bullish move, price formed this high, then we have a pullback, bulls try to push the price again but they fail to break this previous high. And then eventually if price goes down to break this previous low, we can say that this is double top and we can look for our opportunities to enter a sell trade. This is one beautiful example when price formed double top, broke the neckline, retested it and then formed this bearish move. So whoever decided to enter here or here made very good profits. We have a downtrend, one low formation, bulls try to push the price up, bears try to push the price down, but they fail to break this previous low. We have strong bullish move and then you can enter after this breakout here or wait for a retest and then enter. Now I want to give you one very important tip. In my opinion, the best combination to trade is double bottom and bullish engulfing candlestick pattern, and double top and bearish engulfing candlestick pattern. When a bullish engulfing candlestick pattern forms as a second bottom and then price breaks this neckline, there is very high probability that price will reverse and go up. And also when a bearish engulfing candlestick pattern forms as a second top and then price breaks our neckline, there is a high probability that price will go down. This is small but very useful tip that you should know about double bottom and double top chart patterns. I see this pattern constantly, I trade it often, and I think it is the best chart pattern. Here on this chart you can see double top formation, we have uptrend, price formed this first top, second top, it broke this neckline and continued to go down. After that we can immediately see that price formed double bottom chart pattern. It formed this first low, second low, and as I mentioned before, we have this bullish engulfing candlestick pattern. Price broke our neckline and then we can see this massive bullish move. So now let's say that you decided to enter after a breakout here. We can see the price continued to go down, so it was a very good entry point. And here once the price formed this bullish engulfing candlestick pattern, let's say that you decided to enter, we can see the price form this massive bullish move, so we can easily say that this is basically a perfect entry point. It doesn't matter which strategy you use, if you trade chart patterns at all, but double top and double bottom should definitely be included in your strategy. And at the end I want to show you this pattern that nobody is talking about, but I think it is very useful, and it is pattern that I call V-shape because it has the shape of a letter V. So what we can see here is a downtrend and then price formed this massive bearish move, and then immediately after that we can see this strong bullish move. But then we have this low period, but what is important here is the fact that price formed this lower high. So we have this strong bullish move, but it failed to break this previous high. Sometimes you will see this V pattern and price goes up to break this previous high, and in that case you want to wait for a retest and then look to buy. But usually what you will see is a strong bullish move that is not strong enough to break this previous high. In this case, you can look for opportunities to enter a sell trade and catch this previous downtrend here. This is the pattern that I basically see every single day. Sometimes I trade it, sometimes not. It depends on the fact if we have uptrend here or downtrend, or maybe we have a consolidation. But anyway, this is something that I see basically every single day. This is more advanced pattern, but it occurs very often. It usually occurs in a New York and London overlap session. It can also occur right before the news or right after the news. This is the time where we have high volatility, and that's why price is able to form these strong bearish and strong bullish moves. When the market is slow and there are no movements, then this pattern is not very useful. So in order for this pattern to occur, there needs to be a high volatility. If you look closely on your charts, you will see this pattern often, and you can definitely consider to form the plan around this pattern and to trade it. If you consider this video to be helpful, please like and subscribe so you can continue to make more. Thank you very much for watching and see you in the next video. Bye bye.